Everyone in this space talks about the Roth IRA like it's the only path to tax-free retirement income. Max it out, pay taxes now, and withdraw later without owing a dime. It's become almost reflexive advice. It's also not the full picture. Hi, I'm Mark Wisniewski, president of Southern Incomes. I work with retirees and people approaching retirement on tax efficiency, specifically on how to structure your income so you're not handing over more than you have to once those paychecks stop. And one thing I keep running into is how often the Roth conversation shuts down before anyone asks whether it's actually the right tool for that particular person. The faulty assumption. Start with the faulty assumption the whole strategy is built on, that your tax rate will be higher in retirement than it is now. For a lot of people, that's simply not true. When you stop working, your taxable income often drops. No salary, maybe a pension and Social Security and some investment income. Your effective rate in retirement can end up lower than during your peak earning years. If that's your situation, you pay taxes up front into a higher bracket to avoid taxes later in a lower one. The math ran backward. If you're watching this and not sure whether your tax rate in retirement will actually be higher or lower than it is now, that is the question worth answering before you commit to any strategy. Book a call with me and we'll look at your specific numbers. The link is in the description below. And then there's the access problem. Roth IRA contributions are capped at $7,500 a year or $8,500 a year if you're 50 or older. If your income is above a certain threshold, you can't contribute directly at all. The backdoor Roth exists, but it comes with its own complications and isn't available to everyone in every situation. So, what do high earners do with their money that they can't put in a Roth? A different tool, permanent life insurance. There's an option most people in this conversation never reach. Certain permanent life insurance policies structured specifically for cash accumulation rather than just death benefit. I know how that sounds. Life insurance as a retirement strategy has a reputation problem, mostly earned by expensive whole life policies that were sold hard and really delivered poorly for decades. What I'm describing is different. A modern policy designed with accumulation as the primary goal, funded properly over a long enough horizon, can provide an additional source of tax-advantaged accumulation and retirement income without the contribution limits or required minimum distributions that apply to some traditional retirement accounts. Here's how the income piece works. When you take a distribution in retirement, you access the cash value through policy loans. Those loans generally aren't considered taxable income as long as the policy stays in force and it isn't classified as a modified endowment contract. No 5-year rule, no age 59 and a half restriction, no RMD forcing you to take money out in a year when you do not want the income. There's also something most people overlook. Because policy loans generally aren't treated as taxable income, they may have less impact on income-based calculations, such as Medicare premiums or the taxation of Social Security benefits, than taxable retirement account withdrawals. Those stealth taxes catch people badly, and structuring income to avoid triggering them is a legitimate planning advantage. I want to be straightforward about when this makes sense and when it doesn't, because it genuinely is not for everyone. It tends to work well when you're a high earner who's already maxed out your 401k, can't contribute directly to a Roth, and have a time horizon at least 15 to 20 years before you need the money. If you can fund it consistently over that period, want flexibility to access funds before traditional retirement age, and want to leave a tax-free death benefit to your family, then it's worth a serious look. It doesn't make sense if you haven't maxed out your 401k and Roth contributions yet. Do that first. If you're within 5 or 10 years of retirement, there may not be enough time for this strategy to overcome the policy's internal costs. If you need every dollar liquid, this isn't the right vehicle. And if you can't commit to funding it for at least a decade, don't start. The fee objection comes up every time, and it's fair. These policies have internal costs a Roth IRA doesn't. But comparison only holds if you can actually fund a Roth. And for someone earning $300,000 a year, direct Roth contributions may not be available. The real comparison is often between a taxable brokerage account, where investment income and realized gains can create ongoing tax consequences, and a properly structured policy where growth is tax deferred and distributions may come out tax advantage under current rules. That's a different calculation. Important caveats. One practical note before you do anything with this: policy loans and withdrawals reduce your available cash value and death benefit. And if a policy lapses with outstanding loans, you could end up with a taxable event. These policies carry fees and insurance charges that need to be reviewed carefully. Guarantees depend on the claims paying ability of the insurer. This is a tool that should be evaluated with someone who understands both the insurance and the tax planning implications. The big picture. Here's where I leave you. The question was never really Roth versus no Roth. It's what combination of accounts produces the most tax-efficient income for your specific situation over the full length of your retirement. The Roth is a good answer for a lot of people. It's not the only answer, and for some people, it's not even available. Understanding the full range of tools, not just the ones that get repeated in every single video, that's how you build a strategy that actually holds up. If you want to work through what makes sense for your numbers, the link below will get you on my calendar. See you in the next one.